Much is said about the lines that hold the price on a chart. The trading world stands still, awaiting a bounce from invisible walls. We call these walls support or resistance, words that are far too simple. They create an illusion of a mechanical market, where price merely knocks and retreats. However, the true value of these levels lies much deeper, beneath the layer of common rules. We must learn to see not a line, but the actual cause of its emergence. It is not a physical obstacle, but the fixation of the collective attention of big money. Forget schoolbook definitions of horizontal zones. Support is not a place where buyers are always stronger than sellers. Resistance is not a point where selling always defeats the urge to buy. These are points of maximum concentration of past decisions. When price reached a certain mark, it recorded a significant volume of trades. This forces major players to return to that same mark later. We look for traces of activity, not static lines in the sand.
The real work begins when we ignore chaotic touches. A chart always leaves many insignificant tracks. We must find the places where the price sharply changed its trajectory. A sharp turn or prolonged accumulation indicates something important. This is a place where significant capital was injected at a specific moment. It is these areas that act like a magnet for price in the future. Price is simply a reflection of the struggle between two forces. Support and resistance are zones where one side temporarily gave up. In a strong move up, resistance marks the moment buyers exhausted their energy. Support shows when sellers finally decided to take a pause. Understanding this process gives you an edge. It forces you to think about money, not geometric shapes. Our task is to visualize this hidden struggle. Look at the chart as a battlefield where lines are merely boundaries. We don't just draw horizontal lines through candle shadows. We outline the area where big money left its strongest footprint. The more time the market spent in that zone, the more important it becomes.
The market functions as a vast, complex memory. Every important price level stores information about trades. This information doesn't disappear. It influences future actions. Large funds and hedge structures operate with enormous volumes. They cannot quickly close or open positions without damaging the market. Therefore, they always return to the same price zones. This return is necessary to fulfill their primary tasks. They must either add to a position or distribute a volume already accumulated. For example, if an institutional player bought a lot of an asset at the 100 level, they will return to 100. There, they will wait for new buyers to sell the product to, or they will look for sellers to pick up more assets for their strategy. This is the internal nature of price attraction to significant marks.
When price approaches an old, important zone, attention grows exponentially. Here, the interests of traders from different time frames converge. Those who bought there earlier wait to close trades at break-even. Those who missed the move wait to finally join in. This creates an ideal environment for major players. They use this collective attention as liquidity. Levels are essentially expectations. The market is filled with expectations of return, revenge, or profit-taking. As the price approaches, all these expectations activate simultaneously. This creates the momentum we see as a bounce or a breakout. Our job is to understand which expectations prevail at a specific moment. This allows us to take the right side of the trade. Orders to buy and sell are always waiting in these zones. These are the locations where liquidity, necessary for continued movement, is concentrated. Our goal is to place our order where significant players are already standing. We simply disguise ourselves among them, utilizing their strength. This requires precision and great patience.
Every powerful movement requires a period of recovery. We call this period the tension discharge phase. Imagine price made a strong leap upward, breaking through several marks. Now, major sellers must wait for the price to return. This return allows them to sell their large volumes to buyers who have regained faith in the growth. They use this zone as an exit platform. If we see a strong bounce from a level, it indicates the presence of large volume. This volume could be either a buy or sell order. But this volume is not infinite. It always has limits. Each subsequent approach to this level reduces its strength. A major player gradually discharges their position into the market. This is a crucial point for our understanding.
The real trap is hidden in breakouts. Many traders see a level break and immediately enter in the direction of the movement. Often, this is just a false manipulation by a large player. They allow the price to go slightly beyond the zone to activate the stop-loss orders of small players standing near the line. This provides the liquidity needed to finish filling their volume. Understanding discharge helps us avoid early entries. We should not act as soon as the price reaches our mark. Instead, we must wait for confirmation of position exhaustion. Only when the momentum fades can we plan a trade. Our task is to join the smart player, not the crowd. A level break followed by a quick return is a classic example. This is called a false breakout or a trap. It indicates that the big player hasn't finished their business yet. They used the liquidity spike to close part of their orders. This behavior should be our signal for caution. We must learn to read intent behind price movement. If a level is tested for the third time and the bounce is weaker, it is a sign of exhaustion. The strength of resistance vanishes as the volume behind it runs out. The sellers who stood there have already partially realized their positions. The fourth approach will likely result in a breakout, a true impulsive exit from the zone. It is important for us to distinguish accumulation from distribution. Accumulation is the quiet, gradual building of a position by a large player. Distribution is its gradual sale during rising interest. Both processes occur in support and resistance zones. These zones are the ideal places for these secret games. We must constantly evaluate the history of the zone, how many times it was touched, how quickly the bounces occurred, and whether those bounces were impulsive or slow and lethargic. The more energy spent defending a zone, the weaker it becomes. Therefore, we do not trade old levels the same way as new ones.
Seneca wrote, "We suffer more often in imagination than in reality." This applies to the market as well. Many fears regarding breakouts are merely imaginary sufferings. Real risk occurs when we blindly trust simple lines. We must see not the line, but the volume standing behind it. Our task is to understand that with every touch, part of the volume is absorbed. A level should be viewed as a finite resource, not an eternal shield. It is this dynamic that makes these zones so attractive to work with. It requires a constant reassessment of the situation.
Between Heathenism and Christianity, by Charles William Suber. We suffer more often in imagination than in reality. Seneca. This phrase, which served as the leitmotif of our breakdown of market architecture, is not just a quote. It is the key to understanding the nature of human fear, which, in the market, translates into lost capital. In his fundamental work, Charles William Suber explores an era of great transition, the shift from the pagan world to Christianity, where the figure of Seneca stands as a bridge between ancient wisdom and emerging values. Why is this book essential for a trader? Discipline of the mind. Seneca taught us to see things as they truly are, without illusions. This is exactly what we do when we discard lines in the sand to seek real volume. The architecture of decisions. Just as the great ideas of the past shape the present, old price levels shape future movements. This book helps you understand the logic behind large-scale systems. Resilience in chaos. Trading is a struggle against one's own perception. Suber's work provides a deep philosophical foundation for those striving to control their reaction to external noise. This work is more than just history. It is intellectual training for those who wish to see deeper than the crowd. It will help you cultivate the clarity of thought that is the hallmark of professional trading. Purchase the book and deepen your understanding of the nature of decisions through the link provided below. Link to the channel under the video.
Not all horizontal zones are created equal. Our first task is to filter out the noise and select only the significant ones. Significance is determined by depth, i.e., the time scale. A level formed on a daily chart is always more important than one on an hourly chart. It reflects decisions made with greater capital. If the price reversed on a weekly chart, it is a true magnet. This level will attract attention for months or even years. Therefore, we must begin our analysis from high timeframes. We mark only those points where a large, visible turn occurred. These are our fundamental landmarks. On lower timeframes, we look only for confirmation. For example, if we identified an important zone on a 4-hour chart, we move to a 15-minute chart to refine the entry point. But we never trade a level formed only on a 5-minute chart. There is too much noise. The depth tool requires attention to the time of formation. If price spent a week forming a range, it is a powerful base. If price simply bounced quickly and moved on, it is a weak level. We need places where a real accumulation of forces took place. We don't draw a thin line, we draw a rectangular zone. This is an acknowledgement that the market is not perfect and does not react to the penny. This zone should include the bodies of the main candles and the most significant shadows. This provides us with a safety buffer. We evaluate the strength of a level by the price reaction. The first touch of a strong zone always causes an impulsive bounce. This is the reaction of those who missed out earlier and those taking profits. This first test is often the strongest. As the price returns to the same zone a second time, the reaction will be weaker. Part of the volume has already been discharged, as discussed earlier. The bounce will be less pronounced, and the space for movement narrows. We already prepare for a possible breakout, even if the level still holds. The third touch is a critical moment for most zones. If after the third approach the level is not yet broken, its strength is being depleted. We need to be extremely cautious when trading from such a level. It is the ideal place for a false breakout to form. A real breakout occurs after a long accumulation right at the level. This is building pressure when the price cannot move far away. It literally sticks to the resistance or support. This is a sign that sellers or buyers can no longer defend it. This is the preparation for an explosive movement. Our task is not to guess, but to react to these tests. If the first bounce was 500 points and the second only 100, we know what to do. We reduce volume or ignore the third approach entirely. We trade the strength of the reaction, not the line itself. The market constantly generates noise that can be distracting. Small, insignificant fluctuations around a level are a trap. We need a filter to separate real action from imitation. This filter is related to the departure from the zone. If the price breaks the zone by only a few points, we ignore it. This is often the collection of stop losses or ordinary market volatility. We require the price to make a significant move beyond the zone. This move must be palpable, as seen on an hourly chart. For filtering, we use a minimum number of candles. We wait until 2 consecutive candles close outside the level, and these must be candled bodies, not just long shadows. Only this confirms the true intent of the breakout. This allows us to avoid false signals. Many traders enter too early when they see the first break. Then the price returns and they suffer a loss. We wait for a clean, powerful signal. This is the mark of a patient and intelligent trader. Ignore levels that form in a very narrow, illiquid range. They do not have enough strength to attract large capital. We need history where price moved with momentum. Only then can we trust the zone. We must also consider how the price approached the level. If it arrived impulsively, expect a quick bounce or a breakout. If the approach was lethargic through a series of small candles, this is accumulation. This indicates preparation for a major action. Once a zone and its strength are identified, we look for the ideal entry point. We don't just place a limit order on the line. That is too risky, as it allows for a false breakout. We wait until the market confirms our scenario. If we are trading a bounce from support, we wait for the sellers to stop. This looks like the formation of a candle with a long lower shadow. The shadow shows that price was rejected from the low. This means buyers entered the game at this specific spot. This is our first indicator. We enter the trade when the price begins moving in the opposite direction. Our entry point will be slightly above the high of this bounce candle. We place our stop loss under the low of the same candle, but with a small buffer. This minimizes our risk in case the movement continues. When trading a breakout, we act differently and more conservatively. We do not enter immediately after 2 candles close above the level. We wait for the price to return to the broken zone, This is called a retest. This is the classic check of the breakout strength. Broken resistance becomes new support, and vice versa. We wait for the price to touch this new support, and from that touch, we look for candle confirmation to enter. This is our safest way to enter after a breakout. In this way, we allow the market to show its intent. We do not predict, we simply follow a strong impulse. The patience to wait for a retest or a clear rejection is discipline. This eliminates most impulsive, erroneous trades.
Price action architecture is not about drawing lines. It is about understanding how and why large capital leaves its tracks. Support and resistance are merely terms to record these important events. They show the places where a change of power occurred. We have learned to determine the depth, strength, and formation time of zones. We know when to trust a level and when to ignore it. Our advantage lies in seeing the process of position discharge. We don't catch a falling knife. We wait for it to land. Trading requires constant internal work and analysis. We must abandon hasty decisions and blind faith in perfect models. The market is always dynamic, and our tools must be flexible. We use logic, not emotional reaction.
Philosophy also has a place in our trading. Your personal resilience to market noise and temptations. It is the ability to act when the crowd panics or yields to euphoria. Our task is to always stay outside of that crowd. Professional trading is a game of expectations and patience. You don't have to be the best in the world to be profitable. You only need to be more disciplined than most. This is the key advantage that separates the successful from everyone else. To see the chart as it is, without illusions or hopes, that is the deepest understanding of market architecture. That is our ultimate goal.
We must always look at the scale we are in. A level that appears to be resistance on a daily chart might be intermediate support on a weekly. It is necessary to have a clear hierarchy of zone importance. We do not enter a short trade against strong monthly support. Also, pay attention to the time when the last action occurred. The fresher the market memory, the stronger the reaction to that zone. Levels formed a year ago have less impact on current trading, though they remain important as historical markers. The price movement after a bounce is also an important indicator. If the bounce was strong, but the price failed to hold high, it's a bad sign. Buyers revealed themselves but lacked the strength to continue. This suggests continued pressure.
If after a retest the level immediately catapults the price upward, it is a confirmation. This indicates the arrival of new, fresh capital. We always look for this new impulse to join. This is a reliable sign of a zone's change in role. We must develop an instinct to reject weak signals. Every trade must have a solid justification. Do not risk capital if you doubt the strength of a zone. It is better to miss a weak signal than to incur an unpredictable loss.
The size of the zone also matters for our analysis. An overly wide zone shows uncertainty and chaos. A narrow zone, conversely, points to a precise trade by a large player. We prefer narrow, clearly defined horizontal areas. Price often creates voids between important levels. These voids are filled very quickly, like a vacuum. It is important to realize the potential for movement to the next significant zone. We use these voids to define our targets. When price hangs between two levels, it is a waiting phase. The market is gathering strength before a new, stronger exit. During this time, it is better not to trade inside a narrow range. We wait until price moves beyond these limits.
Study the behavior of candles when they reach the boundary. This is the last battle before liquidity is absorbed. Long shadows indicate a refusal to continue the movement. A candle closing near its high or low indicates a continuation of intent. Always keep the full market picture in mind, not just one zone. This allows you to avoid trading against a strong trend. Levels serve as our entry points, and the trend serves as our direction. We combine them for maximum efficiency. We must constantly adapt our zones to new data. Over time, old levels lose their relevance. Every new high or low creates new points of attention. We update the market map with every important movement. Remember that the market always has a reason for returning to old prices.
It is not an accident, but the pure logic of capital management. Our job is to decode this logic. We treat the chart as a historical document. A retest of a zoom should occur with less volume. If volume spikes sharply upon return, it's a sign of a continued struggle. If volume drops, it's a sign that players have lost interest in the zone. This is our indicator to exit. Do not rush to move your stop loss as soon as price bounces. Give the market room to breathe and for potential noise. We only move the stop when the price has truly established itself in our direction. This is a defense against premature actions. Your confidence must be based on facts, not intuition. Support and resistance are the actual collision points of capital. They provide us with objective boundaries for risk. Use these boundaries wisely. We cannot control price movement, but we control our reaction. This is the only thing that truly matters in trading. Your architecture is your method, not just lines on a screen. Maintain clarity of thought.